Most people who hit $100,000 in actual invested assets for the first time destroy it within 3 years. Not through some catastrophic crash, not through a market meltdown, a housing collapse, or a particularly unlucky quarter. Through 4 decisions that are completely rational, feel genuinely deserved, and are quietly endorsed by every person in their life. That is the part that makes this situation so fascinating and so expensive, and what separates this video from every other take on the 6-figure milestone you have ever seen. Charlie Munger said it at a Berkshire Hathaway shareholder meeting back in the late 90s. The first $100,000 is a B word, he said, but you gotta do it. I don't care what you have to do. If it means walking everywhere and not eating anything that wasn't purchased with a coupon, find a way to get your hands on it. After that, you can ease off the gas a little bit. And here is the problem with that advice. Most people heard ease off the gas and immediately drove the car into a ditch, because $100,000 is not a finish line, it is a gear shift. And if you do not understand what exactly it is shifting into, you will spend the next decade genuinely confused about why your balance never seems to grow the way it should. More importantly, the habits that got you to 100,000 are the opposite of the habits that grow it past there. And almost nobody warns you about the switch. Here is what I am going to show you today. At exactly 6 figures, your money changes jobs. Before that number, you are the engine. Your savings rate, your income, your contribution every single month, that is what does the lifting past. But past 100,000, a second engine switches on. Compounding starts pulling real weight. And that shift is where almost everything goes wrong. I am going to run the math on 4 decisions people make at this milestone and show you exactly which one costs the most. Because the answer is not the one anyone expects. I've also been investing for over 10 years across multiple hundreds of thousands of dollars. And the things I am going to tell you are the things I had to learn from my own accountants, my own fiscal lawyers, and occasionally from my own expensive mistakes. But stay with me, because in a few minutes, I am going to show you something about tax-advantaged accounts that almost no one thinks about at the right moment. And it is an ordering error that quietly costs people hundreds of thousands of dollars over a working lifetime. First though, let me introduce you to a snowball. Munger compared building wealth to rolling a snowball down a long hill. The longer the hill, the bigger it gets. What he did not say, but what the math absolutely shows, is this. The snowball's only real enemy is the person carrying it, not the weather, not the terrain. The person who decides to pick it up and bring it inside where it is warm. Every move someone makes with their first $100,000 falls into one of 2 categories. They either leave the snowball on the hill or they pick it up. Remember that phrase, because I'm going to use it every time someone makes a decision that sounds smart and costs a fortune. $100,000 at 8% average annual returns. And the S&P 500 has historically returned around 10% nominally. So 8% is a deliberately conservative estimate. Generates $8,000 in a single year. $8,000. That is $667 a month created while you sleep, while you sit in traffic, while you do literally anything else. For the first time in your financial life, your money is out-earning a part-time job you never clocked into. Below 100,000 contributions do almost all the heavy lifting. Above it, the math starts to flip. And this is where John comes in. John is 52 years old. He runs warehouse operations for a distribution company and earns $58,000 a year. He has been steadily investing for 19 years, never making headlines, never picking a hot stock, never doing anything interesting. Last Tuesday, he opened his brokerage app and saw $100,000 for the first time, 6 figures. The number every finance video swears will change your life. And immediately, his brain started doing something very predictable and very expensive. It started looking for a reward. John has 3 coworkers who hit the exact same milestone in the same year. Diana, Carla, and Maya. Same starting line, same balance, 3 completely different decisions. By the time this video is over, you will see not just what each of them chose, but the specific dollar figure that each choice cost them, and why John's result at the end was not lucky, it was structural. This is where it gets genuinely interesting, so stay with me. The first thing most people get wrong at $100,000 has nothing to do with how they spend the money. It has to do with what happens inside their brain the moment they cross it. For years, that number was the target. The discipline had somewhere to point. Every skipped restaurant, every held raise, every boring automatic contribution had a destination. Then they touch it, and the target vanishes. And without a next target, the brain does exactly what brains do when they run out of objectives. It defaults to the easiest available reward. Psychologists call this goal completion. You achieve the thing you were chasing, and the motivational system that fueled the chase collapses. It is why people finish a diet and immediately gain the weight back. It is why someone trains for a marathon and then sits on a couch for 12 months. And it is exactly why six figures, without a next milestone already named, quietly destroys more wealth than any market correction on record. Because a bear market is temporary. The spending that fills a goal vacuum tends to become the new baseline. Maya is the clearest example of this specific failure mode. 28 years old, a nurse, earning $64,000 a year, careful and deliberate with every dollar she kept. When she hit 100,000, something shifted. Not into celebration mode, into freeze mode. She was terrified of losing what had taken her years to build. So she left every single dollar sitting in a savings account, earning around 3%. No volatility, no uncertainty, no scary red numbers on any screen. Now, you might be thinking, that sounds responsible. That is exactly what makes it so insidious. At 3% annual inflation, Maya's $100,000 lost $3,000 of purchasing power in the first year alone. Her balance stayed perfectly still. What that balance could actually buy shrank every single month. Over 10 years, keeping that money in cash instead of investing it did not just cost her the difference between earning nothing and earning something. At 8%, that $100,000 would have grown to over $215,000. In savings, at 3% real return, it stayed roughly flat in real terms. The gap, over $80,000 in lost growth. Her so-called safe option guaranteed a slow, silent, permanent erosion. Here is the reversal that changes how you think about this. Risk is not a property of the stock market. Risk is a property of time. Over a 30-year horizon, a diversified broad index fund has never permanently gone to zero. Over 30 years, cash has never maintained its purchasing power. The dangerous option and the safe option are switched from where most people intuitively place them. And Maya's fear was completely real. She pointed it at the wrong enemy and paid for it quietly, a little every month, for years. The fix for what happened to Maya is also the fix for the broader goal vacuum problem. Set the next number before you finish celebrating this one. The night you hit 100,000, write the next target, somewhere physical, 250,000, 500,000, a million. A named, concrete next goal gives the discipline somewhere to point again. It closes the vacuum before the brain fills it with anything else. This is not motivational advice, it is brain architecture. The presence of a specific next target measurably changes how you allocate impulse control and attention. John did this. The night he hit six figures, he wrote his next number on a sticky note and put it on his monitor. It is still there 2 years later. In a few minutes, I am going to show you what happens when you take the money that should have compounded and aim it at a better opportunity. It is one of the most common decisions at this milestone, and Carla's story is going to cost her a number that is going to make your jaw drop. But first, let me tell you what lifestyle creep actually looks like when you do the math properly. Because this is the most expensive mistake of the four. It arrives without a single dramatic moment, and it affects far more people than gambling or overcautious cash ever will. Diana is 34, a marketing manager in Denver, earning $72,000 a year. It took her 11 years of steady saving to push past 100,000. And the night she crossed it, she felt something she had not felt in a long time. She felt like she had finally made it. Which, to be clear, she had. 11 years of discipline is genuinely hard. The problem is, what feeling like you've made it does to your brain's decision-making in the months that follow. Diana upgraded her car. The payment went from $0 to $540 a month. Then a nicer apartment, $400 more per month, for a view she admitted she barely looked at once winter hit. Then the dinner rotation shifted upward. The streaming subscriptions stacked. The little upgrades that each individually are completely defensible. A treat here, a convenience there. None of it felt reckless in isolation. Every single upgrade was a rational response to finally having room to breathe. But here's what happened to the math. Diana's monthly spending increased by roughly $1,100 across all those changes combined. $1,100 a month is $13,200 a year, redirected away from investing. Invested at 8% over 20 years. That $13,200 annually compounds to over $600,000. Diana did not lose $100,000. She lost the future that $100,000 could have built. $600,000 of it, through a car payment and a nicer view, and subscriptions she barely thought about. Here is the data that shows this is not a Diana problem. It is an American problem. According to Bureau of Economic Analysis data, for March 2026, the US personal savings rate sits at 3.6%, less than half the long-term historical average of 8.4%. A 2024 analysis found that the average American household spent $77,280 in 2023, a 5.9% increase over 2022 against a 4.1% inflation rate. People did not just keep up with inflation. They spent faster, and a 2024 survey found that roughly 48% of Americans earning $100,000 or more per year still live paycheck to paycheck, the milestone everyone is chasing, and nearly half the people who hit it have nothing to show for it because the spending grew faster than the account balance. Here is the psychological mechanism underneath this. Lifestyle upgrades give a quick dopamine hit, then become the new baseline you stop noticing entirely. This is called hedonic adaptation, and it is one of the most well-documented findings in behavioral psychology. The new car smell fades in 6 weeks. The nicer apartment becomes just where you live. The view you barely look at. And now you need another upgrade to feel the same hit while your old spending level feels permanently acceptable. The upgrade treadmill has no top rung. The fix is deciding your lifestyle before your income decides it for you. Set a number, write it down. This is what I spend on housing. This is what I spend on transportation. This is what I spend on everything else. Then every raise, every bonus, every income improvement automatically splits. Part goes to lifestyle if you choose. Part goes to investments before it hits your checking account, invisibly, automatically, before your brain can argue with it. This habit, consistently applied, is the entire difference between Diana's real ending and the one her 11 years of discipline deserved. By the way, if this kind of breakdown is useful to you, hit subscribe. YouTube's algorithm has a habit of not showing you channels again if you don't signal some interest, and I put a serious amount of time into these numbers. Here's the part I want to pause on before we go further, because understanding the problem and having a system to solve it are genuinely two different things. Knowing that lifestyle creep exists is useful. Building a framework around that knowledge so that your specific numbers become a specific exit date is a completely different thing. And that gap is exactly why I spent close to a year building something called the exit code. The timing angle here is directly relevant to this video. The moment you hit $100,000 in invested assets is the exact first moment that the math of early or on-time retirement becomes calculable. You have a base that now compounds at a speed you can measure and project, but most retirement calculators assume you contribute linearly, withdraw at the standard 4%, and experience no behavioral friction along the way. Reality does not work like that. The lifestyle creep rate I described, the goal vacuum effect, the tax drag on unoptimized accounts, those variables change the math significantly. The exit code is a digital book I built on 50 years of actual retirement data, not opinion, not theory, not someone's newsletter guesswork. 2 chapters that connect directly to what we are discussing are what I call the 58% rule, which addresses the buffer you need against a forced exit from the workforce before you are ready which happens to 58% of workers, according to research from the Employee Benefit Research Institute and the 4% Trap chapter, which shows why the standard withdrawal framework breaks down in real sequence of return scenarios and what the dynamic withdrawal method does differently to protect against a bad luck early retirement. It is built to take your actual numbers and turn a vague maybe someday into a specific defensible date. You can get it through the link in the description for less than what you would spend at a decent restaurant. And the math I just showed you is the reason every year you spend without a framework like this compounds against you. Now back to the snowball and Carla. Carla is 32, a software tester earning $81,000 a year, impatient by nature and proud of it. She hit $100,000 in 7 years by living lean and investing hard. Boring index funds, automatic contributions, maximum 401k at every job, the whole discipline system. But once she crossed 6 figures, something shifted in her thinking. Boring felt insulting for someone as capable as her. She had done everything right. She deserved a bigger move. So she transferred $40,000, 40% of everything she had built over 7 years, into individual stocks and leveraged options contracts she had been researching for 3 months. For 3 weeks, it worked. Her $40,000 became $52,000, and she felt like a genius. The feeling of genius inside an investing account is one of the most dangerous feelings a human being can experience because it arrives right before the correction. Then the trade turned. The same leverage that multiplied her gains multiplied her losses at exactly the same rate. In 9 trading days, 52,000 collapsed to 19,000. She had destroyed $21,000. More than that, she had surrendered years of compounding she will never recover. Had Carla left that $40,000 in a broad index fund at 8%, history says it becomes approximately $130,000 by her mid-40s. She traded that outcome for a maybe, and the maybe cost her. There is a rule almost nobody follows, because following it requires a kind of honesty about yourself that is genuinely difficult. Your first $100,000 is not risk capital. It is your foundation. You do not bet the foundation to build the second floor faster. You will end up with neither the floor nor the roof. If the excitement of active investing is genuinely important to you, and for some people it is, wall off 5% of your total portfolio. Put it in a completely separate account with a different login. Call it your play money account. Treat it like an expensive hobby, and let it be the most expensive hobby you have. When it burns, and most of it will eventually, your foundation never feels the temperature. Carla's fundamental error was that her excitement and her long-term savings shared one account, one interface, one login. There was no wall. Now here is the invisible killer nobody puts in the headline, because it is boring. You think the problem is picking the wrong investments, but actually the problem is the friction cost on the right ones. A 1% annual management fee on $100,000 sounds like nothing. That is $1,000 a year. Manageable. Fine. But here is what that number actually means. Over 30 years, starting with $100,000, at 7% gross return with no fees, you end with $761,000. The same $100,000 at 7% minus a 1% annual fee, meaning effectively 6% growth ends at $574,000. That is a difference of $187,000 extracted silently from your account by a fee that was never listed as a line item. According to FINRA research, over 20% of investors believe they pay 0 fees at all, and nearly 40% of mutual fund owners do not know they pay fund operating expenses. The fees are deducted automatically from the net asset value of the fund, invisibly, every day. You never see a bill, you never feel a withdrawal, and you never see the $187,000 you do not have. Low-cost broad index funds typically charge between 0.05 and 0.20% annually. An actively managed fund often charges between 0.75 and 1.50. The gap between those numbers, sustained for 30 years, is a second car, a down payment, a decade of retirement security, or a college education, silently reassigned to someone else. This is the entire case for passive, low-cost investing. Not because it feels impressive, because the fee savings compound. And compound returns on fee savings, sustained over decades, produce an outcome that active management statistically cannot match after costs. According to S&P's SPIVA research, the vast majority of actively managed funds underperform their benchmark index over 15 and 20-year periods after fees. The boring fund wins. Leave the snowball on the hill. Here is where Marcus enters the picture. And I want you to keep track of him because his story runs parallel to John's for the rest of this video. Marcus is 2 years older than John. He works the same warehouse, hit 100,000 2 years before John did, and made a completely understandable move when he crossed it. He shifted everything into a self-directed brokerage and started picking individual stocks. He read the earnings reports. He followed the analysts. He knew the companies. And for the first 8 months, he beat the index. He mentioned this at lunch several times. Then he stopped beating it. Then he started losing to it. Then he added a 1% managed fund because doing the research himself was exhausting and he had stopped enjoying it. By the time John hit 100,000, Marcus had been stuck near that same balance for almost 2 years. His decisions were reasonable. His results were predictable. Every active choice looked smart in isolation. Together, they produced the outcome that passivity would have avoided. Stay with me, because the next section is the one that almost never comes up in six-figure conversations, and it is the one with the clearest mathematical impact. At this milestone, most people have been investing for years. The question that almost no one asks at exactly this moment is my money in the most tax-efficient home? This matters more than the specific funds you are in, more than your allocation percentage, and in some cases, more than your contribution rate. There are two piles of money. Pile one is in tax-advantaged accounts, a 401k, a Roth IRA, an HSA if you have a qualifying health plan. Pile two is in a standard taxable brokerage. In 2026, the 401k employee contribution limit is $24,500. The Roth IRA contribution limit is $7,500. The HSA individual limit is $4,400. Combined, that is over $36,000 per year in tax-sheltered capacity. Most people do not come close to filling it, and almost nobody checks whether they are filling it in the right order. Here's why the order matters. In a standard taxable brokerage, your dividends and capital gains get taxed annually. That tax drag compounds against you silently, the same way fees do. In a Roth IRA specifically, you pay tax once, now, on the money going in. Then every dollar of growth inside it for the rest of your working life, and then throughout your retirement, is never taxed again. A dollar inside a Roth IRA and a dollar inside a taxable brokerage are not the same dollar. Over 30 years, they are dramatically different dollars. The two-pile rule is simple. Fill pile one before you add anything to pile two. 401k to at least the employer match first, because that match is an instant 100% return before the market does anything at all. Then the Roth IRA to the annual limit, then the HSA if you qualify, because an HSA is the only triple tax advantage account in the tax code. Contributions are pre-tax, growth is tax-free, and withdrawals for medical expenses are also tax-free. Then, and only then, let excess savings flow into a taxable brokerage. This one ordering decision, maintained without interruption over a working lifetime, can add hundreds of thousands of dollars to your outcome, not because you pick better investments, but because where the money lives changes how much of the growth you eventually keep. John checked this the month he hit 100,000. He found that some of his money had been sitting in a cash sweep account inside his brokerage, meaning it was not even invested, it was parked. He moved it. He maxed his 401k to the employer match. He funded his Roth IRA for the year. He checked his expense ratios. 3 changes in one afternoon that changed the trajectory of his next 20 years. Now you are asking yourself about debt. This ambushes almost everyone at six figures. You have 100,000 invested, but you still carry a car loan, a credit card balance, maybe old student debt. The instinct is to feel wealthy and ignore the debt because you have an asset now. That instinct has a price. The clean rule: compare the debt's interest rate against your realistic expected investment return. Any debt charging more than roughly 8%, which includes credit cards at 18 to 26% and many personal loans, beats almost any investment on a pure mathematical basis. Paying off a 20% credit card is a guaranteed 20% return with zero risk and zero volatility. That is better than any bet you will ever make in any market in any year. Destroy high interest debt first, aggressively, without exceptions. But low interest debt is genuinely different. A 3% fixed rate mortgage in a world where your diversified portfolio averages 7 to 8% does not need to be rushed. You keep investing alongside it because the spread between the debt cost and the investment return is working in your favor every month you carry it. John had one credit card at 19%. He cleared it the same month he hit $100,000. Then he kept his low-rate car loan, kept his contribution rate unchanged, and moved on. The math told him exactly what to do. He did not need to agonize about it. Marcus update. Somewhere around the 18-month mark, after John hit six figures, something changed at the warehouse. Marcus stopped talking about his portfolio at lunch. He had quietly and without announcement moved most of his money back into a low-cost index fund. The performance chasing had produced 2 years of essentially flat returns. The index he had been trying to beat had climbed. He did not admit this out loud. But his account balance started climbing again. For the first time in 24 months, the moment he stopped trying to outperform the market and started letting the market do its job. The subplot resolves there. Marcus figured it out. He just paid several years of tuition to get there. John's advantage is that he never started. Let me make John's situation concrete with the actual math, because this is where the numbers stop being hypothetical. John is 52, $100,000 invested, $58,000 a year. His situation does not look like a retirement brochure, but here is what the arithmetic actually says. At 8%, the rule of 72 tells you that money doubles every 9 years. 72 divided by 8 equals 9. So by 61, before he even considers retiring, that base becomes $200,000 without a single additional dollar contributed. By 65, it reaches roughly $245,000 from the base alone, but John has not stopped contributing. He currently puts in about $600 a month, which is roughly 12% of his take-home pay. $600 a month invested at 8% for 13 years adds approximately $173,000 on top. Total by retirement age, over $400,000. That generates over $16,000 a year at the standard 4% withdrawal rate, before a dollar of Social Security, before any other savings, just from the $100,000 he crossed on a Tuesday in 2026. The point is not that John becomes spectacularly wealthy. The point is that John's boring, automatic, unchanged system produces an outcome that the majority of Americans approaching his age will never reach, simply because they picked up the snowball somewhere along the way and never got it back on the hill. Diana spent her compounding. Carla gambled hers. Maya let inflation drain hers. And John, who changed nothing when the milestone hit, is the only one whose money is actually doing the job it was finally capable of doing. Here is the test that arrives eventually for every investor at this level. An expensive emergency, a medical bill, a roof, a job disruption, a family crisis. And suddenly, the invested pile looks like a rescue fund. This is the exact moment people tear a hole in the snowball and never fully patch it. They sell in a panic, often at the worst possible moment in the market cycle, and they reset years of compounding in a single afternoon. This is why the emergency cash cushion is not optional. It is the mechanism that protects the snowball from you. 3 to 6 months of living expenses in cash, sitting in a high-yield savings account, completely separated from investments, completely off limits except for an actual emergency. This pile is the shield. With this shield in place, an emergency hits the cushion and the snowball never feels it. Without it, the snowball is the first thing people reach for. Maya, for all her overcaution, actually built this part correctly. Her mistake was keeping everything in cash. Her wisdom was keeping enough cash for exactly this scenario. The lesson is proportionality. enough cash to weather the storm. Everything beyond that planted where it can compound. Now, let me make the automation concrete enough to actually use. The system that works is also the system that removes willpower from the equation entirely. Every payday, a fixed percentage moves automatically to investments before you can see it. What you never see, you never miss. This is not a motivational phrase. It is demonstrated psychology. When the transfer is automatic and pre-scheduled, you do not make the decision to invest every month. You made it once. And the research on decision fatigue is clear. Humans are dramatically better at making one good decision than at making the same good decision 420 consecutive times over 35 years of market volatility, job changes, and emotional noise. John uses a two-component system. First, automatic contribution to his 401k and Roth IRA every payday, before the money touches his checking account. Second, and this is the more powerful part, every time he gets a raise, the raise automatically splits before he adjusts his lifestyle. Half goes to investments first. He lets his lifestyle grow on the other half, slowly, intentionally, not at the full rate of the income increase. This habit is the engine, because raises are the exact danger zone where lifestyle creep plants its flag. Most people get a 3% raise and upgrade their spending by 3% within 60 days. John gets a 3% raise and invests half of it before he can feel tempted by the other half. His wealth grows faster than his lifestyle. That gap, wealth outpacing lifestyle, is the quiet mechanism under every genuinely comfortable retirement. He checks his accounts roughly once a year, rebalances if something has drifted significantly, checks expense ratios once, then closes the app. That is it. If it ever feels thrilling, he knows something has gone wrong. The system is supposed to feel boring. Boring means it is working. Carla rebuilt. After the $21,000 loss and 4 months of paralysis, she set up the 5% play money wall she should have had from the beginning, opened a completely separate account for it, and moved everything else back into index funds on automation. 18 months after the worst trading week of her life, her balance was back past where she started. The system she had built for 7 years before she gambled, she resumed it. It required no new knowledge, no special insight, no financial advisor charging 1% of her assets to explain half of it. It required only going back to the thing that worked before confidence got expensive. Let me zoom out and give you the broader statistical context, because this number deserves to be understood in terms of how rare it actually is. According to the Federal Reserve's 2022 Survey of Consumer Finances, the most comprehensive household wealth data available in the United States, the median net worth for Americans under 35 is $39,000. For ages 35 to 44, it is $135,000. For ages 45 to 54, it is $247,000. And critically, those figures include home equity. Strip out home equity and the numbers drop significantly. The median American, excluding home equity, has far less invested liquid capital than these numbers suggest. $100,000 in actual invested assets, money working in the market, puts you in rare company at virtually any age, which is exactly why the next decision at this milestone carries so much weight. You fought to reach thin air. Most people who fall back do not get pushed off the ledge. They step off themselves. And that is genuinely good news, because it means the biggest variable in your outcome is not the market, it is you. You cannot control whether the market drops 20% next year. You can completely control whether you stay in your seat when it does. And staying in your seat through the noise and the volatility is the entire discipline. Not picking the right stock, not timing the entry, just not selling when everyone around you is selling. Here is where the 4 stories converge for the final accounting. 3 years after Diana, Carla, Maya, and John all crossed the same $100,000 starting line. Diana, after 3 years of $1,100 monthly lifestyle upgrades, sat near the same balance she started with. Her income had risen meaningfully. Her lifestyle had risen to match it every single time. The snowball never got the fuel to move. Carla, after her 9-day trading loss, an 18-month recovery, sat near 90,000, behind where she started, but climbing again for the first time in 2 years. She picked the snowball up, she put it back. It is moving now. Maya, her balance still, reading 100,000 on the screen, its real purchasing power now quietly lower than the day she hit it. The inflation meter running the whole time she sat perfectly still. The number looked the same. The world had gotten more expensive while she watched. And John, who changed nothing. Same funds, same contribution rate, same boring automatic system, $174,000. 3 years, no drama, no exciting trades, no celebration purchases, no complicated strategies, the least interesting story of the 4, and by a distance, the best outcome. The single line worth writing down from this entire video. The first $100,000 is the last time your effort matters more than your patience. Getting to 6 figures rewards hustle, consistency, and monthly contribution. Growing it past there rewards stillness. Those are opposite muscles. The people who get rich from here are not the smartest or the most active. They are simply the most willing to leave the snowball on the hill and walk away. Here are the 3 things to do the moment your portfolio crosses 6 figures, calibrated specifically to this milestone. First, do not make a single reward purchase in the first 30 days after you cross it. The urge to celebrate is loudest exactly at the milestone. Let it pass before you act. The upgrade you buy in week 1 will stop feeling like an upgrade by week 6 and will have cost you compounding for decades. Second, check the account ordering today. Confirm that you are filling tax advantage space first. 401k to the employer match, Roth IRA to the annual limit, HSA if you qualify. Only then does anything extra go to a taxable brokerage. This one check, done once, in the right sequence, can be worth more than any stock tip you will ever receive. Third, name the next number right now. Not this weekend, today. Write 250,000 or 500,000 or whatever your next milestone is on something you will see every single morning. The same discipline that got you to 100,000 needs a destination, or it will find something less useful to attach itself to. Lazy investing built more fortune than crypto memes. John is still at the warehouse. He is not watching charts at work. He is not day trading on his phone. His brokerage app gets approximately 6 minutes of his attention per month, and the number is declining. His snowball is rolling on its own now, getting heavier with every quarter, while everyone around him tries to carry theirs inside and wonders why it keeps getting smaller.